After an incredible run in 2020 and a slightly less savory 2021, Cathie Wood and her ARK Invest firm have put out their quarterly report, among other commentary. Some of the predictions surrounding 2022 sounded alarm bells throughout online conversations. Cathie Wood and her analysts are predicting a market recession that could be on its way. This may sound bad at first, but every movement of the market brings an opportunity for profit. That being said, if her theory turns to reality, you'll need to be prepared. Hey guys, welcome back to Profit Protection Channel. In this video, we're going to break down the ARK Invest quarterly report to get a better understanding of what might cause a market crash. After that, we'll go over things that you can do personally to protect your profit and even maybe capitalize on a crisis. So stick around, we've got plenty of valuable info headed your way. As always, this channel does not give out financial advice. Everything you choose to trade is under your discretion alone. Despite this, we aim to bring you the most valuable and intelligent ideas from the thought leaders across the finance space. We genuinely believe that the information we provide makes you a better and more informed investor. Alright, so as we mentioned, Cathie Wood and her ARK Invest firm recently announced some concerning signs about a possible market crash headed our way. In a recent interview, Cathie mentioned notes from a Federal Reserve detailing plans to begin raising interest rates more aggressively. This is quicker than expected from many analysts who were assuming that the Fed had planned to take action later in the year. It now seems as though officials are looking into beginning raising rates during March. Interest rates must be raised eventually to influence consumers to save. This happens because return from savings are higher when rates are raised. With less disposable income being spent, the economy slows and inflation decreases. It's a delicate balance that must be struck by the Fed to raise rates without crippling the economy. Another warning sign that could cause difficulty for the market is the mass movement of investors from growth stocks to value stocks. People are becoming more risk averse, taking their money out of popular growth stocks to more dependable and established value stocks. This actually influenced the market, bringing it down to start the year off in the red. Cathie likens this to the unfortunate .com market crash, where a mad rush into growth and tech stocks created an unbalanced relationship between them and value stocks. The result was a bubble that popped and sent the market into a never-before-seen recession. This is similar in ways to what we are seeing today, as innovative tech companies became the favorites of investors across the country. This shift, accelerated by the pandemic disrupting so many economic factors, has created a similarly precarious situation for our market today. Now, as investors begin to question whether they should continue to hold these tech stocks, a danger looms ahead.
Danger, Will Robinson.
You could call it the perfect storm. So how would you, as a retail investor, position yourself in market conditions like this? Before we answer that question, let's see what Cathie Wood's does. Cathie Wood's ARK ETFs had a stellar 2020 in the heat of the pandemic, but 2021 was not quite so profitable. Cathie's innovative investing strategy was mirrored across the market in 2020 when institutions and retail investors alike flocked to disruptive tech companies. In the mad rush to get on board, many seem to miss the fact that history felt as though it was repeating. Just as expected, the people are now backing down from the exciting technologies and innovations that once attracted them. Suddenly, they feel as though the tried and true value stocks will give them the protection needed from a market downturn. ARK Invest, much like these investors, was also capitalizing on the innovation and disruption seen across many such industries and companies. The difference between retail, other institutional investors, and ARK is that the Cathie and her team are sticking to their strategy. 2020 was incredible for ARK Invest, with its largest ETF racking up massive change, growing 150%. 2021 was not quite so hot as investors began to fear a downturn. While ARK ETFs may have performed worse, neither they nor the market settled back to previous levels. This leads us to where we are now, at a possible tipping point. If this change of tune in the market from growth stocks to value stocks turns into a mass exodus, the momentum could do much more than hurt tech companies. It could bring the whole market down with it. Not every share sold is another share bought, and if the sell-off picks up speed, fewer investors will feel comfortable putting their money back in. Assuming this snowballs, we could be facing a massive recession, even as much as 90%. So, what is Cathie's strategy if her prediction comes true? There's a reason Cathie Wood is in charge of $60+ billion of investor money. She has an uncanny ability to recognize disruptive companies and technologies, as well as the foresight to invest smart and invest hard. When she has a plan, market downturns don't scare her. As with any account manager, emotions take a backseat. This is where her trading strategy should shine, in theory. Cathie Wood and ARK Invest are not abandoning their tech and growth stocks that make up such a large piece of their pie. This time, Cathie thinks the tech bubble is different. According to ARK Invest report and her comments from interviews, these new tech stocks are companies with robust operations and proven profit. She compares this to the dot-com crash, which consisted of many tech companies that just couldn't quite back up their business plans. The internet was in its infancy, and many of these companies could have been labeled as vaporware. In other words, the hype that built the bubble before was due to companies being too conceptual and over-promising their innovation. Now, because so many advanced technologies are overlapping to foster real growth, any dip presents itself as an opportunity. When the world runs back to value stocks, Cathie Wood predicts that our growth rates are going to look far superior to anything you would find in the value space, and we are really looking forward to that. Equity benchmarks are trading at nearly record high valuations and record high prices. These are the safe investments that many are retreating to. This is part of why ARK Invest is so confident in its investment strategy. These companies are largely similar in terms of services and operations compared to a decade or two ago. These new companies are being beaten down, yet continue to hit landmark development in technology and solutions. When the market begins to fall harder, the emerging hierarchy of technology and innovative services are going to establish themselves as the new value stocks. Because traditional value stocks will struggle to evolve, this leaves investors with a golden opportunity to get in early on the next big thing, for lack of better words. These companies are already settling themselves up as opportunities for incredible value. Let's take two examples from Cathie's most recent article on the ARK Invest website. She points out something that is often overlooked by investors. Case number 1, Zoom. Zoom is going through a tough spot, or so it would seem. Since it peaked in October of 2020, the stock has fallen 68%. At first glance, this appears to prove that the company is struggling since work from home stopped being all the rage. That picture is actually wrong. As of 2021's third fiscal quarter, Zoom is actually generating $1.5 billion more in annual revenue than the last time its stock price was this low. As you can see, the company has actually continued to grow its operations and more customers and generate more revenue. Despite this, investors have been leaving it in droves due to fear. Case number 2, Teladoc. You can probably guess where this is going. Teladoc acquired Livongo in October of 2020 to further integrate itself into remote healthcare. It's currently sitting at a stock value loss of 70%. The last time Teladoc had this low of stock value, it was bringing in $0.7 billion annually in revenue. Despite shares having been beaten down, the company is doing $2.1 billion in annualized revenue. Once again, we see how investors have been scared off of growth stocks despite their stellar business operations. These are only two of many cases that we see around the market. They may be the most extreme, but they tell a story that is applicable to many innovative companies. Cathie believes that any large market downturn will essentially put powerful growth stocks on sale. And for those that can pick them up at a discount, there are insane upsides. So in this case, what can you do personally to prepare for a possible stock market crash? And since you are here, hit that like button to give some feedback to the YouTube algorithm. If you are a financial institution or a hedge fund with massive amounts of capital, any downturn is an opportunity. With millions of dollars laying around, they jump at the chance to scoop up stocks. As a retail investor, you don't have quite as much freedom. You want to keep your money somewhere where it will enjoy a high return in the coming years. You can't wait around for the perfect day. Luckily, Cathie feels as though this is a straightforward problem to solve. According to ARK Invest quarterly report, the usual benchmark investments will fail to hold up in the coming 5 and 10 years due to how powerful innovation is becoming today. It is their belief that now is the time to turn to the new generation of companies that are changing the world and disrupting their industries. Cathie even goes as far to say that benchmarks are unlikely to generate even average return over the next 5 to 10 years. So, you heard it here, folks. If you are confident in the analysis and research of Cathie Wood and ARK Invest, it's in your best interest to begin leaving the archaic benchmark industries and companies behind. Your portfolio needs to highlight the disruptive industries and technologies that will deliver the results that older corporations cannot. As the masses return to their familiar stocks and benchmark funds, the tech companies that are left behind will continue to produce real-world results. These real-world results will translate to real-world profits when investors recognize the opportunities for long-term profits that are offered by new and disruptive companies in each industry. Now, if you really want to know more about how you can make money even when the market is crashing, you should see this next video, where we have outlined a strategy on how to survive a bear market. If you enjoyed this video, please hit the like button to show your appreciation for our efforts and consider subscribing to Profit Protection. Happy researching, invest safe, invest smart. We'll see you on the other side. Take care.